There's a number that's become difficult to ignore, and it's hiding in the financial pages where most retirees never look. In just 2 months, September and October of 2025, U.S. investment-grade tech companies issued $75 billion in new corporate debt. That's more than double the sector's average annual issuance of $32 billion between 2015 and 2024. Bank of America expects this number to exceed $100 billion in 2026. This debt explosion is not a sign of strength. It's a signal that the artificial intelligence infrastructure boom, the story that supported stock market valuations for the past year, is exhausting the cash available to support it. When companies that are supposedly generating record cash flows need to borrow record amounts, something fundamental has broken in the narrative. For someone approaching or in retirement, this matters more than the headlines suggest. The debt that tech companies are issuing needs to be repaid. That repayment comes from future earnings. If those earnings don't materialize as expected, or if interest rates remain elevated, the debt burden becomes crushing. And crushing debt burdens at major corporations tend to precede market corrections that devastate retirement portfolios. Let's examine what's actually happening. The big five technology companies, Amazon, Microsoft, Alphabet, Meta, and Apple, are spending a combined $527 to $600 billion annually on capital expenditures. Roughly 75% of that spending, $400 to $450 billion, is directed at artificial intelligence infrastructure, data centers, GPU purchases, networking equipment, and cooling systems. These are not small investments. This is the largest capital spending cycle in the history of the technology industry. Historically, major technology companies generated enough cash flow from operations to fund their capital spending without borrowing significantly. Microsoft, Google, and Amazon were designed as asset-light companies that generated enormous cash relative to their capital needs. That dynamic has fundamentally changed. In 2025, the Big Five hyperscalers generated approximately $577 billion in operating cash flow. They spent approximately $443 billion on capital expenditures. That left roughly $134 billion in free cash flow. But they also had to fund debt service, interest payments on existing debt, shareholder returns, buybacks and dividends, and working capital. After all those obligations, there was not enough cash to fund the level of AI Capex they wanted to deploy. So they went to the debt markets. And the debt markets, which were previously skeptical of tech debt, have accommodated them. Over $428 billion in bonds were issued by global tech companies in 2025. The United States accounted for $341.8 billion of that. This is the largest debt issuance cycle for tech in recorded history. But here's where the warning signal becomes clear. Companies wouldn't need to borrow this much if they genuinely believed their AI investments would generate returns quickly. The fact that even highly profitable companies are borrowing record amounts suggests that either, 1, they don't believe the returns will come fast enough, or 2, they need the debt funding for balance sheet flexibility, which means they're uncertain about near-term cash flow generation. Both scenarios are problematic for retirement portfolios. Morgan Stanley and JP Morgan Chase analysts project that tech companies may need to issue $1.5 trillion in additional debt over the coming years to finance AI infrastructure construction. UBS analysts estimate as much as $900 billion new issuance coming in 2026 alone. To put this in perspective, the total debt issued by the entire U.S. corporate sector was approximately $1.2 trillion in 2024. Tech companies alone are expected to issue debt at rates that rival all of corporate America in a normal year. This accumulation of debt matters for two interconnected reasons. First, debt service costs are rising. When you borrow money at 5% interest, you're committing 5% of your future earnings to debt repayment in perpetuity. When a company like Meta borrows $30 billion, $33 billion goes to Oracle, and billions more from Amazon and others, the cumulative interest obligations become substantial. For every $1 billion borrowed at 5%, that's $50 million in annual interest payments. For the Big Five combined, the cumulative interest obligations on the AI Capex debt could easily exceed $3 to $5 billion annually. Second, and more importantly, that debt only makes sense if the AI infrastructure investments generate returns that exceed the cost of borrowing. If AI investments return 10% and borrowing costs 5%, you generate positive spread. But if AI investments return 3% and borrowing costs 5%, you destroy value. The spread goes negative. And this is where the market is beginning to express concern. Research from Man Group, one of the largest hedge fund managers, specifically noted that while tech companies are exceptionally well capitalized and highly profitable, there's a significant funding gap that debt markets are being forced to fill. But more importantly, Man Group raised a critical question. Can debt markets bear an oversupply of lower quality AI companies and infrastructure providers issuing debt at record rates? The answer increasingly appears to be no. Evidence for this is showing up in the cost of borrowing. Applied Digital, a company specializing in data center construction, was recently forced to pay 75 basis points, 0.75% more in interest than similarly rated competitors to borrow money. That's approximately 70% higher interest costs. The market is signaling cautiousness. Newly issued bonds from AI infrastructure companies have seen their prices plummet, a signal of investor reluctance. The cost of credit default swaps, which serve as insurance against corporate defaults, has surged recently for certain AI company debts. This credit market stress is an early warning signal. Historically, when credit markets begin to express concern about corporate debt, through widening spreads, higher interest rates, and declining bond prices, equity markets follow within weeks or months. The credit market is forward-looking. It's pricing in the probability that some of these companies will struggle to service their debt if returns on AI infrastructure don't materialize as expected. Here's the mechanical reality. A company borrowing $30 billion at an average interest rate of 5% is committing to pay approximately $1.5 billion annually in interest. That $1.5 billion comes out of future operating earnings. If the company's AI infrastructure generates $3 billion in annual operating profit, gross profit before depreciation, interest, and taxes, then the $1.5 billion interest payment means you're dedicating 50% of your AI profits just to debt service. That doesn't leave much for taxes, reinvestment, shareholder returns, or buffer for contingencies. But what if the AI infrastructure doesn't generate $3 billion? What if, like many emerging technologies, the actual returns are 50% less than projected? Then you have $1.5 billion in operating profits and $1.5 billion in debt service. You've just used all your profits just to service debt. You have nothing left for tax obligations, reinvestment, or shareholder returns. The entire profit from the AI investment is consumed by interest payments. This scenario is not hypothetical. Historical technology cycles show this pattern repeatedly. The 5G build-out, the cloud computing build-out, and others required massive Capex investments. Companies borrowed significant amounts. Some generated the returns they projected, others didn't. When returns underperformed expectations, companies had to reduce leverage by cutting other spending, reducing shareholder returns, or in worse cases, restructuring debt. The concern is compounded by the fact that tech companies are now using increasingly sophisticated off-balance sheet financing vehicles to fund AI investments, special purpose vehicles, SPVs, securitized debt structures, data center asset-backed securities. These are all mechanisms for borrowing money in ways that don't show up as traditional debt on company balance sheets. This is financial engineering designed to make debt burdens appear smaller than they actually are. For a retiree evaluating portfolio risk, this is precisely the kind of scenario that requires defensive positioning. The debt issuance itself isn't necessarily dangerous, but the scale of debt combined with the uncertainty about returns from AI infrastructure creates an asymmetric risk. If AI infrastructure generates the returns companies project, debt gets paid down and valuations expand. But if returns underperform, debt service becomes problematic, earnings compress, and stock valuations decline. Consider the real-world timeline. A tech company borrows $30 billion in 2025 and 2026 to build AI data centers. The company projects these data centers will generate $5 to $7 billion in annual operating profit by 2027 to 2028. That's a 15 to 20% return on invested capital, which would be acceptable if achieved. But deployment is delayed due to supply chain constraints. Returns don't materialize until 2028 or 2029. Meanwhile, the company is paying $1.5 to $2 billion annually in interest on debt while waiting for returns. That $1.5 to $2 billion in annual interest payments comes out of other business segments' profits or requires further borrowing. By the time those AI infrastructure returns finally appear in 2028 or 2029, the company has already reduced earnings for 2 or 3 years due to interest expense. Stock valuations, which are based on current and near-term earnings, don't recover until those returns actually appear. That's a 3 to 5 year period where stock price performance is lackluster while debt continues to accumulate. For a retiree in their 70s, 3 to 5 years of lackluster performance is a significant chunk of remaining life. The most concerning aspect is what researchers call the returns on investment uncertainty. Bank of America and other analysts have noted that the ratio of incremental revenue to Capex has declined sharply. In other words, companies are investing more capital per dollar of new revenue generated. This ratio compression is a warning sign that incremental returns on new capital are declining. If that trend continues, even companies with current profitability may struggle to justify the debt burden required to fund future AI infrastructure. Carlyle Group, another major investment firm, noted that tech companies are transforming from asset-light entities with high price-to-book ratios to more traditional manufacturing-like companies. What does this mean? It means tech companies are shifting from software businesses, high margins, minimal capital, to infrastructure businesses, lower margins, massive capital. When a company with a price-to-book ratio of 11x, valuation appropriate for software companies, is now actually an infrastructure company, the valuation becomes difficult to justify. Infrastructure companies typically trade at 1.5 to 2x book value, not 11x. This valuation shift, from software company multiples to infrastructure company multiples, could represent a 70 to 85% decline in valuations if the market reprices these companies based on their actual business mix. That would be catastrophic for retirement portfolios. The debt funding bomb's fuse has been lit. The question is simply the timeline. Will the returns from AI infrastructure materialize fast enough to support the debt burden? Or will companies face extended periods of depressed earnings while they service debt and wait for returns? The debt markets are beginning to price in the latter scenario. When credit markets express caution through wider spreads and declining bond prices, equity markets typically follow. For someone in retirement or approaching it, this is a compelling argument for reducing concentration in the mega-cap tech stocks that are driving this debt issuance. The upside scenario, where AI infrastructure generates massive returns, is already priced into current valuations. The downside scenario, where returns are delayed, investments underperform, and debt service becomes burdensome, is not priced in. The risk-reward is asymmetric. Some defensively minded investors are also watching the financial engineering. When companies begin using special-purpose vehicles and off-balance sheet financing extensively, it often precedes financial distress. The financial engineering is designed to hide the true scale of leverage. But leverage, whether on-balance sheet or off-balance sheet, still needs to be serviced from operating cash flows. One final consideration: Federal Reserve policy matters enormously. If interest rates decline significantly, the interest burden on all this tech debt becomes lighter, and the returns on investment calculation becomes more favorable. If rates stay elevated or rise further, the debt burden gets heavier, and returns on investment calculations become more pessimistic. Current Fed guidance suggests rates will remain elevated longer than previously expected. That's a headwind for tech debt service. The $75 billion in AI bonds issued in just 2 months isn't a sign of strength. It's a signal that the AI infrastructure story is reaching the point where capital intensity is outpacing cash generation. When that happens, debt accumulates. When debt accumulates, financial risk rises. When financial risk rises at major corporations, stock markets eventually reprice downward. Your retirement depends on understanding these signals. The debt funding bomb isn't invisible. It's documented in the bond market data, the earnings reports, and the increasing leverage ratios. The companies are borrowing record amounts to fund AI infrastructure. The bond market is expressing caution through higher interest rates and wider spreads. The equity market has not yet repriced downward, but the warning signal is clear for anyone looking.